Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamowen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today we're starting with some exciting news from the Canadian Real Estate Association. According to their latest report, national home sales surged in October, marking a significant shift from the market's previous holding pattern. Compared to a year ago, home sales rose by an impressive 30%. This increase is a clear indication that the market is gaining momentum after a period of stagnation. On a seasonally adjusted month-over-month basis, national home sales rose 7.7% from September. Last month alone, 44,041 residential properties changed hands across Canada. This uptick in sales activity was widespread, with notable double-digit increases in both the Greater Toronto Area and British Columbia's Lower Mainland. These regions are often seen as bellwethers for wider trends in the Canadian housing market. CAREA's senior economist, Sean Cathcart, described this rise in sales as a surprise, especially as the Bank of Canada continues its trend of lowering key interest rates. In fact, the central bank has reduced its key interest rate 4 times since June, with a recent half percentage point cut on October 23rd, bringing the rate down to 3.75% from a high of 5%. This reduction has made borrowing more affordable for many would-be home buyers. Jason Ralph, broker of record for Royal LePage Team Realty in Ottawa, noted that while fall typically sees an increase in market activity, the numbers surpassed his expectations. He pointed out that the market's recovery appears to be gradual rather than sudden. This gradual rebound can be attributed to the Bank of Canada's clear messaging around its rate cut cycle, which suggests further reductions may be on the horizon. Interestingly, Cathcart mentioned that the sales increase was more likely tied to the surge in new listings that hit the market in September. That month saw a 4.8% rise in new homes, pushing supply to levels not seen since mid-2022. He suggested that we might not see another significant influx of new supply until next spring, and by then, mortgage rates should be nearing their expected lows. CREA Chair James Mabey added that October's robust sales figures suggest buyers have been in the market since rates started to decline in early summer. However, they were waiting for the right properties to become available, which only happened in a big way in September. He emphasized that the future trend will depend heavily on the number of new listings coming to market between now and next spring. Despite the positive sales figures, the number of newly listed properties decreased by 3.5% month-over-month in October, with the national pullback led by a drop in new supply in the Greater Toronto Area. By the end of the month, there were 174,458 properties listed for sale across the country, which is up 11.4% from a year earlier, but still below historical averages for this time of year. The national average sale price for October came in at $696,166, which is a 6% increase compared to last year. Jason Ralph observed that with property prices expected to rise amid growing demand, sellers are gaining confidence to list their homes, while buyers are more comfortable with current price levels. This dynamic seems to be driving increased market activity as both buyers and sellers adjust their expectations. BMO senior economist Robert Kavchich remarked that the positive sales data indicates Canada's housing market is finding some life. He noted that sales volumes have rebounded from last year's lows, prices have stabilized across many regions, and outright buyers' markets are becoming less common. While last October and November were particularly soft, the current activity reflects more selection and lower borrowing costs. Mortgage arrears in Toronto may reach levels not seen in over a decade, according to a recent report by the Canada Mortgage and Housing Corporation. As rising interest rates, cooling housing markets, and increasing non-mortgage credit delinquencies converge, homeowners are experiencing significant financial strain. The report highlights that while Canadian homeowners have shown resilience amid rising mortgage costs, the coming 6 to 12 months could be a breaking point for many. Mortgage arrears, which have been historically low, are beginning to rise and are expected to accelerate over the next year, particularly in Toronto and Vancouver. In Toronto, the market is showing signs of stress, with more homes for sale than there are buyers. This imbalance is making it difficult for struggling homeowners to sell their properties and avoid financial difficulties. The sales to new listings ratio, a key measure of market activity, has been identified as a crucial predictor of future arrears. When this ratio declines, arrears tend to follow within 6 to 12 months. Rising delinquencies in non-mortgage credit products, such as credit cards and auto loans, are also early warning signs of future mortgage arrears. Initially, homeowners tend to prioritize their mortgage payments, but as financial strain mounts, trouble often spreads to all debts within 6 to 12 months. While Calgary, Saskatoon, and Halifax are expected to maintain low arrears rates, Toronto and Vancouver are in a more precarious position. In Toronto, arrears could soar to 2012 levels, driven by a sluggish housing market and increasing non-mortgage credit delinquencies. Vancouver, too, faces challenges, with arrears potentially reaching levels not seen since 2015. High inventory levels and slowing sales are limiting homeowners' ability to exit the market. Meanwhile, cities like Montreal, Ottawa, and Edmonton present a more uncertain outlook. Mortgage arrears are expected to stay within post-COVID ranges, but sharp increases in non-mortgage credit delinquencies across these cities warrant further monitoring, according to the Canada Mortgage and Housing Corporation. A looming challenge for over 1 million Canadian homeowners is the so-called mortgage renewal shock. Many mortgages are set to renew at higher rates in 2025, which, when combined with inflation-driven reductions in disposable income and rising unemployment, could push more households into arrears. The Royal Bank of Canada recently pointed out that a softening labor market poses a greater threat to the economy than mortgage renewals, adding another layer of concern. Rising unemployment could further limit homeowners' ability to manage increasing costs. The Canada Mortgage and Housing Corporation has called on financial institutions to support struggling homeowners through alternative payment arrangements and other tailored measures. The new Canadian Mortgage Charter offers additional guidelines for lenders to address financial distress. The message is clear: complacency is not an option. As we navigate these challenging times, it is crucial for both lenders and borrowers to be proactive in managing financial stress. Today's discussion brings us to a look at the key factors that are expected to influence the Canadian mortgage market in 2025. As we peer into the future, the direction of interest rates and borrowing costs is anticipated to be the most significant determinant of market performance. While impending mortgage regulatory changes and shifts in housing supply will undoubtedly play roles, it is the interest rates that will capture the spotlight. Starting December 15th, we're expecting new mortgage rules to take effect, including expanded access to 30-year amortizations and a higher insured mortgage cap. These measures are widely seen as positive steps to enhance affordability for Canadians. However, Drew Donaldson from Donaldson Capital, a prominent mortgage broker, emphasizes that interest rates will remain paramount in the minds of borrowers contemplating their next moves. Donaldson suggests that buyer confidence could return due to these mortgage rule adjustments, stating, "Whenever there's a rule change or regulatory change that's positive, it brings back good news to the market." Yet, he firmly believes that the real narrative revolves around interest rates. If rates continue to decline, we might witness a very strong 2025. Conversely, if they hold steady, the year might be stable, but not as vibrant as the peak years of 2020 or 2021. An increase in rates, though not anticipated, could slow down the market. On a more optimistic note, the prospect of significant interest rate hikes next year seems unlikely for now. The Bank of Canada has already reduced its benchmark rate multiple times this year, with expectations of further cuts in 2025. Additionally, the 5-year Government of Canada bond yields, which influence fixed mortgage rates, have been on a downward trend through much of 2024, despite some recent fluctuations. According to Donaldson, these trends have already begun to rejuvenate the refinance market, and embolden prospective buyers to venture into the housing market. People are now starting to believe that not only have rates come down so they're more manageable, but that they're going to continue to go down in the future, he noted. This renewed confidence is encouraging for both brokers and borrowers. However, it's worth noting that the Canada Mortgage and Housing Corporation has reported rising mortgage delinquencies and financial strain due to previous higher interest rates. Financial advisor Chris Karam underscores the importance of having a comprehensive financial plan to manage mortgage debt and assets in these uncertain times. As we look ahead, one wild card for 2025 is the potential impact of Donald Trump's return to the United States presidency. His administration's policies could affect Canada, U.S. relations, and the broader North American economy. While some are concerned about possible inflationary pressures from his economic approach, others see opportunities in deregulation and cost-cutting measures. New tariffs could also pose challenges to the Canadian economy. Donaldson remains optimistic, sharing that clients are expressing interest in entering the market now, anticipating that if rates continue to fall, next year could see increased competition and potential bidding wars. "I'm cautiously optimistic," he said. "The worst is behind us. The last 2 to 3 years have been a challenging market in Canada, and I also think the condo market is still struggling, but that's going to work itself out. It's all about interest rates. And I think in 2025-2026, people will be pleasantly surprised by the real estate market in general." In today's segment, we're examining a curious trend in Ontario's real estate market, the departure of longtime realtors from the industry. According to recent reports, seasoned members of the Toronto Regional Real Estate Board are stepping away from the business, facing challenges such as higher professional fees and a more complex market environment. This trend has been highlighted by Toronto realtor Scott Ingram, who notes that membership in the board saw an 8% drop at peak renewal time this year, marking the steepest decline since 1991. Despite the influx of new realtors joining the industry in Ontario, there is a growing concern about the loss of veteran agents. Many of these newcomers are part-timers, and some brokers suggest there could be thousands of agents in the province conducting minimal transactions. This shift raises questions about the quality of service and expertise available in the real estate market as experienced professionals exit the field. Turning to financial products, there's a new offering in the rental market that's catching attention: cashback on rent. As more Canadians become renters, credit card issuers and fintech companies are targeting this demographic with perks like 0.25% cashback programs. While this might seem appealing, it's essential to weigh the costs and benefits. Paying rent with a credit card could introduce new expenses if not managed carefully, as interest charges can accumulate quickly. Shifting our focus to British Columbia, despite the federal foreign buyer ban that began in January 2023, foreign investment in the province's real estate sector has surged in dollar value this year. A recent analysis indicates that foreign involvement in residential transactions reached nearly $824 million in 2024. Most of these transactions involve properties under $1 million, suggesting many are pre-sales that took years to finalize. This trend indicates that the foreign buyer ban may not be as effective as initially thought, prompting calls for a reevaluation of its impact on the market. In a recent opinion piece, it's been highlighted that while homeowners are generally wealthier than renters, this doesn't necessarily spell doom for renters in retirement. The rising costs of homeownership, including insurance, taxes, and maintenance, mean that renting can still be a financially viable option. Renters benefit from lower living expenses and can potentially invest their savings elsewhere, offering a path to financial security despite not owning a home. This perspective challenges the notion that homeownership is the only route to financial well-being in retirement. Finally, let's take a look at the home of the week, located at 38 Lascelles Boulevard in Toronto. This charming 5-bedroom house, built in 1926, is nestled on a quiet street, yet remains conveniently close to the Yonge subway line. It boasts a spacious, formal living room with a wood-burning fireplace, a kitchen with modern amenities, and a deck that opens to a patio. The upper floors contain the bedrooms, while the finished basement offers additional living space. The asking price for this beautiful home is $3.35 million, making it a noteworthy listing in Toronto's competitive housing market. The Financial Services Regulatory Authority of Ontario has recently taken a decisive step in maintaining the integrity of the mortgage industry by issuing a notice of proposal against a licensed mortgage agent, James Hooker. This proposal includes imposing administrative penalties totaling $34,000 and implementing heightened supervision conditions due to multiple violations of industry regulations. This move highlights the importance of adhering to the Mortgage Brokerages, Lenders and Administrators Act, 2006, which sets the standards for ethical conduct in the mortgage sector. James Hooker has been found in breach of several provisions of this act, resulting in penalties of $30,000 for accepting remuneration outside of his authorized brokerage, and an additional $4,000 for providing false or misleading information during his license renewal process. In addition to these financial penalties, the Financial Services Regulatory Authority has proposed a 2-year supervision condition on his mortgage agent license, indicating the severity of these breaches. The Financial Services Regulatory Authority detailed that between March and September 2021, Hooker conducted 4 separate mortgage transactions where he directly received remuneration totaling approximately $21,425. These transactions were not processed through his authorized brokerage, Cash and Mortgages Incorporated, as mandated by his independent contractor agreement. This agreement required all transactions to be conducted through the brokerage to ensure coverage under Cash and Mortgages Incorporated's errors and omissions insurance. Despite these contractual obligations, evidence showed that Hooker, alongside another agent named Eli Benzakin, bypassed Cash and Mortgages Incorporated in these dealings, opting to receive direct payments from clients or third parties. For example, in one transaction known as the MP First Mortgage, Hooker received a $3,500 fee directly from the transaction's lawyer, a payment that was not disclosed to Cash and Mortgages Incorporated. Similarly, in another transaction, the CH Mortgage, he received $2,925 from a financial service fee, again bypassing the brokerage. Elissa Sinha, the Director of Litigation and Enforcement at the Financial Services Regulatory Authority, stated that Hooker intentionally failed to disclose information pertinent to these mortgage transactions to Cash and Mortgages Incorporated. By negotiating and accepting remuneration for these transactions outside the brokerage, Hooker aimed to increase his compensation while concealing these activities from his authorized brokerage. Further compounding these violations, the Financial Services Regulatory Authority alleges that Hooker provided false information on his 2022 and 2023 license renewal applications. He reportedly denied having been terminated for reasons such as theft, dishonesty, or falsifying records, even though his termination from Cash and Mortgages Incorporated on October 1, 2021, was explicitly due to such conduct. These omissions are significant as they undermine the integrity of the licensing system, which relies on accurate and truthful information. While the Financial Services Regulatory Authority acknowledged Hooker's cooperation during the investigation and noted that his infractions were limited to one brokerage, his conduct raised serious concerns about his capability to operate independently as a mortgage agent. The authority emphasized that without additional supervision, there are reasonable grounds to believe that Hooker may not process mortgage transactions in compliance with the Act and regulations. James Hooker has the right to request a hearing before the Financial Services Tribunal within 15 days of receiving the notice of proposal. If he does not request a hearing, the penalties and conditions outlined will be finalized as proposed. This case serves as a reminder of the critical importance of maintaining transparency and adherence to established regulations within the mortgage industry to protect all parties involved. Today, we're turning our attention to a significant development in Toronto's housing landscape. The Government of Canada, in collaboration with the Government of Ontario and the City of Toronto, has announced the start of construction for new affordable homes at 230 Coxwell Avenue. This initiative is aimed at providing housing solutions for Indigenous peoples facing homelessness in Toronto, with a total of 20 new homes being built as part of this project. This development is spearheaded by Nemi Res, a Toronto-based Indigenous nonprofit organization, which will operate the 4-story building. The design includes a common room for cultural events and a first floor tailored for tenants with mobility issues. Completion of the project is anticipated by the winter of 2026. The funding for this project is a collaborative effort with contributions from various sources. It includes $5.8 million from the city's stream of the third round of the Rapid Housing Initiative, $1.4 million from the Ontario Priorities Housing Initiative, $1.2 million through Ontario's Indigenous Supportive Housing Program, $1.2 million from the City of Toronto, and $2.9 million from the National Indigenous Collaborative Housing, Inc. Julie DeBruzen, Member of Parliament for Toronto, Danforth, emphasized the importance of safe and affordable housing in improving economic, educational, and health outcomes. She noted that this project is a step towards creating more equitable housing solutions for vulnerable populations. Ontario's Associate Minister of Housing, Vijay Thanigasalam, expressed pride in the provincial government's $1.4 million investment, highlighting it as a step forward in addressing housing needs for Indigenous communities and strengthening their commitment to providing safe and affordable housing. Mayor Olivia Chow of Toronto remarked on the project's impact, stating it addresses the housing and homelessness crises affecting Indigenous residents. She acknowledged the collaboration between government levels and nonprofits like NAMI Res in delivering meaningful outcomes for Toronto's diverse population. Councillor Paula Fletcher of Toronto, Danforth, expressed her support, recalling her efforts to exempt eligible units from development charges, and looked forward to welcoming new community members. Steve Teekins, Executive Director of NAMI Res, highlighted the importance of culturally relevant housing operated by the Indigenous community, expressing gratitude for the support from all government levels, which will help Indigenous members transition to a healthier and more fulfilled life. John Gordon, CEO of the National Indigenous Collaborative Housing, Inc., praised the For Indigenous by Indigenous approach, which addresses housing needs with community-driven solutions. He commended NAMI Res for responding to a critical need within their community. Lorna Lawrence, Executive Director of Miziwi Beek Development Corporation, acknowledged the funding provided and the collaboration among government levels, underscoring the importance of creating stable, affordable, and culturally relevant housing for the communities most vulnerable. This initiative is part of the broader National Housing Strategy, a long-term plan to provide more Canadians with affordable housing. It prioritizes those in greatest need, including Indigenous peoples and those at risk of homelessness. The Financial Services Regulatory Authority of Ontario, commonly referred to as FSRA, is actively seeking public feedback on its proposed 2025 to 2026 Statement of Priorities and Budget. This document will serve as a roadmap for the regulator's actions over the next year, guiding its strategic initiatives and financial planning. The consultation period, which began on November 14th, will extend until December 6th, providing stakeholders an opportunity to influence the future direction of financial services regulation in Ontario. The proposed priorities for the upcoming year are centered around several key objectives. FSRA aims to enhance consumer protection in a cost-effective manner, emphasizing the importance of engaging with stakeholders more effectively. A significant focus will be on amplifying consumer voices, supporting innovation within the industry, and ensuring that FSRA remains accessible and responsive to all stakeholders involved in the financial services sector. Licensing processes are also under the spotlight, with FSRA planning to introduce new tools and implement recommendations to streamline service delivery for licensees. These initiatives are designed to boost efficiency while maintaining robust consumer protections. This approach reflects a broader trend in regulatory practices, where the balance between innovation and consumer safety is continuously evaluated and adjusted. In addition to these priorities, FSRA is committed to modernizing its systems and internal processes through an initiative known as FSRA Forward. Despite facing some challenges with cost overruns and delays, FSRA is exploring strategies to ensure that this program fulfills its promise of improving operational efficiency and service delivery. This modernization effort is critical to adapting to the evolving needs of the financial services landscape. The Statement of Priorities will ultimately shape FSRA's annual business plan, which is to be submitted to the Minister of Finance for approval. The budget details within this proposal are currently in draft form and will be finalized through the planning process. Stakeholders, including financial professionals and consumers, are encouraged to review the proposed priorities and budget and provide their feedback by December 6th at 11:59 p.m. Eastern Standard Time. FSRA's interim chief executive officer, Stephen Power, emphasized the significance of public consultation in the regulatory process. Public consultation is an important element of our approach to regulation. Your feedback is crucial in helping us to foster a strong, sustainable, and innovative financial services sector and to protect and empower consumers in Ontario, he stated in a press release. This initiative underscores the regulator's commitment to transparency and stakeholder engagement as it moves forward. As we wrap up today's episode, it's clear that the landscape of Ontario's financial services is poised for significant developments. With FSRA's call for feedback, there's an opportunity for stakeholders to play a vital role in shaping the future of financial regulation in the province. It's an exciting time for both the industry and consumers as we look toward a more innovative and consumer-focused approach to regulation. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.